Well, my next guest says, if we really want to get on top of this inflation problem, the Federal Reserve is going to have to aggressively raise interest rates, so much so. We're making a big deal out of where we are now, an overnight bank lending rate of 0.75% to 1%. Now, if Kenneth Rogoff is right, the Harvard University economics professor, former IMF chief economist, you'd have to get to 5 times that level. Professor, very good to have you. I don't know if it's so good to hear that, but you're probably right on that in terms of just getting back to what would be an appropriate norm. But that would do a lot of damage in the process, wouldn't it? Would it risk a soft landing? Would it, in and of itself, cause a recession?
Oh, if they have to raise interest rates that much, it will cause a recession, no doubt. I don't think they'll go that far. My best guess is they fall short. They raise interest rates to 3.5, and we're left with a very soft economy and still inflation 2 years from now, or the end of 2023, in the 3.5, 4 range. I'm not sure. I'm not saying they should do more, because you care about the economy too. Right. But once things have gotten out of hand, it's not that easy to bring it back under control.
Now, I think, Professor, what they're saying is that maybe you don't have to go that high if, in the course of raising interest rates, it starts reversing the inflationary trend. We might already be seeing it in disparate, numbers we're getting that are not accelerating as much as they were. Do you put any stock in that?
These are, a little bit of mild good news, but if you look at the broader picture, it's really hard to see how you're going to get the inflation rate down to, say, 2.5% without having a recession anytime soon. Yeah, I mean, inflation's coming down, but it was 8.6%.
Right. No, you're
so
right.
Bringing it down, we're talking about it coming down, but it is nowhere near where they would like to have it.
Professor, where do you factor in what it means for the stock market? Because the higher rates go, and there's some banks that are touting already 4% CD rates and the like. So we're seeing a little activity there. Hardly the norm, I stress, but for investors, that's not an awful return. It's a way to find an alternative from the craziness of the markets. In other words, could it feed on a market sell-off?
Yeah, I mean, there's a lot of things going on. There's not just what the Fed is doing. The shutdowns in China, their COVID policy, which is a political problem, it's hard to overstate how bad that is. They slow growth. That's a supply shock that keeps coming, that raises prices, lowers productivity. The war in Ukraine's part of the pushing up gas prices. It's pushing up food prices. So there's a lot of things going on, in addition to the fact that we let inflation get out of hand. So I'm not sure that there's sort of like a lot of good news bringing things back in line. The stock market's sort of absorbing all of it. Certain things like tech stocks are particularly sensitive to the interest rate because they're looking to have big profits a long time in the future, and they've been coming down harder.
Yeah, maybe really hard. One of the most targeted of all stock sell-off groups. Professor, very good having you on. Thank you very much. Kenneth Rogoff is his name, the Harvard University economics professor, former International Monetary Fund chief economist. And if he's right, to his point, you have to get up to 5% of the Fed funds rate from just around 1% now. That might do the trick, but it certainly could do in the economy.